Well, we're a half hour from the open in Hong Kong, Shenzhen, and Shanghai. You are watching The China Show. I'm Stephen Engle with David Ingles.
Good Monday morning to all of you. Let's get to your top stories today. Chinese stocks in focus after a rally fueled by policy support took place on Friday. Shares elsewhere, as you can see on your screens, are trading in a fairly tight range here as the region kicks off its busiest week for new listings in more than 2 years. Now, Israel's leadership holds discussions on how to attack on Iran while the military begins targeting Hezbollah's financial networks in Lebanon. Plus, we hear exclusively from Taiwan's premier on why the island is ready to go nuclear to power its chip industry. Again, good Monday morning to all of you joining us from across the Asia Pacific. If you're joining us out of the U.S., of course, good evening. Straight out of the gates, breaking news out of the loan prime rates out of China. We were expecting a 20 basis point, roughly, reduction in the 1 and 5 year. What we did get was slightly more. So we're looking at a 3.1% on your 1 year, 3.6%. That translates, as far as the delta goes, to about a 25 basis point reduction in the 1 year, which is the benchmark, of course, for commercial rates, and the 5 year, it tends to be the reference rate for the mortgages. Keep in mind that this follows and really comes expected after the PBOC reduced its 7-day repo by 20 basis points a few weeks back. So that tends to be the benchmark, of course. There, Steve, what else are you seeing here?
Yeah, no, and this was widely expected with the central bank governor in China, PBOC Pan Gongsheng, essentially on Friday said that they were going to do this. They were going to cut the loan, or actually guide the markets. Yeah. The big banks make the cut to the loan prime rate, and we're getting what we expected on Friday. This, of course, after big banks kept it unchanged in September, but we all know what happened in very late September. There were cuts to interest rates by the PBOC, and there was a raft of stimulus as well, and really encouraging households and corporates, which is very much tied to the 1 year loan prime rate, to start borrowing to boost this economy.
Yeah, and hopefully we'll get that next leg in the rally to be underpinned really by a response in earnings and the economy. As we were talking about market-wise, though, so we are seeing a little bit of an upside right now, a quarter of 1%. So you are getting a pickup. Can we go back, please, to the dashboard, please? Thank you so much here. A tenth of 1% in U.S. futures. Yet again, another record there. VIX futures are coming down. Oil, the other big story, of course, is when it comes to gold. Spot and futures are hitting new highs Monday morning. The Golden Dragon Index on Friday, reminder just in case of how we did. I think we were up also, and we were almost going into the weekend last week with almost a daily decline until Friday happened, of course. And, news out of the PBOC and that swap program to support the markets did enough to lift the benchmarks on Friday, and the Golden Dragon, of course, up 3%. We'll talk more about some of the catalysts this week, potential ones. Earnings, of course, we're moving into the thick of earnings season. About $8 trillion in market cap out of the U.S. reports this week. A50 futures signaling some weakness going into the open today. Your 10-year yield is at 2.12, and dollar China will get the fixing out in about 12 minutes or so. For more on the equity story in China, let's bring in Winnie Su, joining us right now to talk us through this. So, Winnie, I mean, the boost that we got to prices on Friday certainly followed up more of the policies announced, or details of the policies announced in September. Has investors' confidence started returning after what I think was a week and a half of soul-searching for Chinese markets?
Yeah, finally, we're seeing some confidence starting to return, especially when we heard that announcement on Friday from the PBOC saying that providing more details around the swap facility and also the relending facility. So that really helps investors start to realize that, okay, this time the government is really keeping its promise. And because they promised more back in September, saying that they can provide even further support as needed. So people are expecting now that there are more policies to follow through. So the Friday boost, or the Friday announcement certainly was a big boost for the sentiment in the market. And that followed, as you mentioned, just kind of lots of briefings throughout the week. We had earlier the briefing by the Housing Ministry, and before that, the Finance Ministry. And those were welcoming, but they were kind of underwhelming. So having that optimism coming back on Friday with those PBOC announcements, along with we saw that GDP data that was better than expected, but still fell below 5%. So market is expecting the government to step in for more support, and that can potentially be that catalyst for the rally going forward.
Hey, Winnie, Steve here. Obviously, Dave talked about soul searching. I think a lot of people were doing sort of a floor searching as well on the recent pullback. What's going to be the catalyst going forward this week? Because it's going to also be a big IPO week across Asia Pacific, but a couple of big IPOs as well as China Resources Water, or the bottling company, and also, I believe, an autonomous driving company.
Right. So kind of that, just seeing more IPO activities within the market is something that people are very excited about, because that can be kind of showing how much excitement there is in the market. And just looking at that turnover, we know that, while we see a little bit of pullback in the market recently, it's still up about 20% since the beginning of the rally. And as long as that volume and the turnover stays elevated, that means that there is still a lot of activity and excitement about the market. So overall, the market sentiment in that case will remain strong. And in terms of other catalysts people are looking at, that includes some of the macro numbers that will be waiting to come for October numbers, and to look at the retail sales and also property sales to see if there is some sense of recovery since the announcement of from the government end of September. And also we'll be looking at earnings. We're going to get the third quarter earnings results pretty soon. And right now, the expectation remains quite low, but people are seeing some bottoming in terms of earnings estimates going forward, with expectation that the stimulus will help with the company's earnings.
Yep, and we'll get a few big names coming out with earnings today out of Greater China. ZTE, Ping An are among the names, of course, set to report today. Winnie, thank you so much getting us warmed up for the week here. Our Asia equities reporter over in Tokyo. I guess just a brief history lesson. So Chinese markets, MSCI China 31% up from the initial leg, down 12% up on Friday. So from the bottom, we're up about 17% net from September 23rd. Joining us here in set, Gabriela Santos, Chief Market Strategist for the Americas at JPMorgan Asset Management. Welcome to the region.
Thank you, thank you.
Hope you're not too jet lagged. Oh, it's 9 p.m. your time.
So far, so good. Thank you.
You're fine. How receptive are people that you talk to on your side of the world to the bull case in China?
I think we've gone through a few phases in the China story. So before early 2021, there was a lot of reception from institutional clients to really grow their strategic allocation and dedicated allocation to Chinese equities, right? It had gotten to be nearly 40% of MSCI emerging markets. Since then, the last 3 years, the conversations have been much more focused around risk management and a rethink of what the right risk premium is to invest in China, given domestic geopolitical uncertainties. What's the right way, vehicle, asset allocation to invest in China? And I think that's still a bit where we are with the clients that we speak to in the U.S., in Latin America, even in Europe. Now, I do think it will depend where we go from here. I do think that foreign investor maybe is looking at this perhaps as a tactical rebound, and for it to truly go back to being a more strategic, growing allocation, I think their expectations are higher for the foreign investor.
There's still a lot of uncertainty, though. I mean, in the second quarter, I think you saw a record level of outflows from Chinese equities. There has been a bit of a reversal because of the stimulus and because valuations were fairly cheap. But there's so much geopolitical uncertainty with the election in the United States coming up as well. How long-term a trend is this, to getting back in when cheap is good, or is cheap also risky.
Exactly. And we've seen these ranges over the last few years in China, right? Valuations get very, very discounted. The PE gets to 8 times, 9 times, and then there's some kind of catalyst, and then you get these really strong rebounds. You had it earlier this year, January to May. MSCI China was up 30%. And we have seen in terms of flows just over the last, really since September 24th, inflows of $12.7 billion into China-dedicated ETFs by foreign investors. But whether that's just a foreign investor trying to make a tactical call versus the strategic allocation, I really think it's still the former at the moment. And 2 questions the foreign investor has. Number 1, on fiscal, looking for a bigger number, a boost to fiscal spending. Or a number, period. And a bigger number, right? The rumbling for a foreign investor is 2 to 4 trillion yuan, whether that's this year or next year. The second thing is demand side focused versus just supply side. And then the third, as you alluded to, the U.S. election and some rumblings and pricing of uncertainty around tariffs and trade.
How much of it, and this is very hard to quantify, so just to, as an answer to be a fair question, is investor psyche. That's, these are investors who, to your point, were overweight 40% of the benchmark before, but just got burned in the last 3 years. And, how high is that hurdle for them now to, whether it's a big number or something else, for them to dip back in a structural way, to your point?
I do think it's a fairly high hurdle. And so far, the fiscal discussions are much more on the cyclical side, right? Yeah. That we're discussing here is a way to start to boost a little bit confidence and spending, especially by households. But I think there's an important structural element here. I do think the hurdle is high enough that foreign investors are looking for slightly more structural reforms aimed at boosting private confidence in a more sustainable manner, and hence lowering the risk premium for investing in Chinese equities. Now, that doesn't mean they're not investing at all. Right? It's just that it's become much more targeted, much more active management, really focused on especially A-shares, domestic demand, business innovation, and the energy transition supply chain, and keeping existing positions and just rethinking them versus net new money and growing a strategic allocation. There we've seen focus on EM Asia and other parts of EMX China.
So again, you kind of follow what the priorities are being set by the government as well. The new 3 into batteries, into solar and EVs and the like. So is that the recommendation that you're giving to clients right now?
Exactly. And really, for decades now, it has been very much focused on the policy priorities, the areas receiving support. And really, the pivot there was particularly painful for domestic and foreign investors in 2021. But very much, it's, kind of following the blueprint of policy priority, but with a tweak. So, for example, domestic demand, before it was all about the growth of the Chinese middle class and really trading up and focused on luxury. And now it seems like a more cautious Chinese consumer, more focused on domestic brands. So there's been a bit of an evolution, as well as, for example, the energy transition supply chain. So maybe it's not necessarily the EV makers themselves, but maybe it's the batteries that go into it. So where can you actually see profit growth and multiple expansion?
Yeah, the EVs, they're not making money, but the supply chain is not bad, right?
Exactly.
All right, Gabriela, sit still. We're going to come back to you in just a minute, and we're going to talk about more things, including what's on tap for the Fed. Gabriela Santos, Chief Market Strategist for the Americas at JPMorgan Asset Management. And we are counting down to the open of trade in Shanghai, Shenzhen, and Hong Kong. This is the China Show.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Right, welcome back. So the China story for now, a reduction 25 basis points on 1 and 5. Your reference rate for today is out, 709.82 against the, well, that's the midpoint, so slightly stronger slightly stronger than estimates right now. We're also moving into a key week, of course, lots of IPOs, big earnings. Of course, we're coming off some key earnings out of the U.S. In terms of what that looks like from a market cap basis in the U.S., just to give you a sense of how busy things will get. Relatively busier. We're looking at about $8 trillion of market cap reporting this week, and it's really when you move into the 28th is really when some of the bigger names on aggregate start to report earnings as well. Bottom of your screen should be coming up on your set to TSMC out of the gates up 1%. It takes us straight into how do you trade the AI story at this point in time? U.S. growth stocks in particular. Gabriela Santos still with us, Chief Market Strategist for the Americas at JPMorgan Asset Management. I mean, long AI still remains a key theme for many investors. It's really the how to do it. You broaden out beyond 3 to 5 names. What's the advice?
Exactly. So last year was all about the Mag 7 and just kind of calling that the AI trade. I think this year is which Mag 7. And here a big focus on return on investment and actual monetization of AI. And then number 2, beyond tech, what other sectors are exposed to this AI investment, both digital and physical? And here utilities. U.S. utilities really stand out because of this surge in electricity demand and the need to really upgrade the electrical grid. So utilities are up as much as tech this year in the U.S., 30%. And then number 3, you mentioned it earlier, it's thinking a bit more globally about winners from the AI trade. A lot of that, of course, Taiwan, up quite nicely this year. And I think investors are on the watch for Korea as well, once you get a bigger sense of when the actual memory chip cyclical turnaround is really gaining some legs.
And investors out in this part of the world are a little bit uncertain what the Fed's going to do now. A month ago, they did cut by 50 basis points. Now there seems to be a growing chorus that maybe they went too far. They're going to wait a little bit longer. Raphael Bostic, Atlanta Fed president, was saying, I'd rather have patience right now. That sort of sends a mixed signal to Asians, doesn't it?
I think they're really looking to very gradually normalize interest rates. The first move, 50 basis points, was just kind of a warning shot out of the gate, maybe a bit of a makeup for not having cut in July. From here on out, our expectation and now the market's expectation is 25 basis points a meeting. We do think that's doable. It would get you to closer to neutral by mid next year or closer to 3%. Now, to get additional easing from that, I actually don't think equity investors should cheer for that, because that probably means the economy is weakening. If there's this gradual rate cut because the economy is doing perfectly fine, then that's actually a good thing for equities, for corporate credit, and for global equity markets as well.
So broadly on fixed income, what is the appropriate strategy now, given that, we saw a massive drop in yields, then we've corrected? What is appropriate duration at this point?
Yeah, so what we had been seeing is a lot of global investors, when they thought U.S. fixed income, they had very ultra-short cash-like fixed income. Right. 3-month T-bills, 6-month T-bills, which were paying over 5%, which is great. But those are exactly the yields that came down after the Fed cut rates and that are going to keep coming down. So step 1 is increased duration, but just a bit. There's a sweet spot in our view around 3 to 5 years where you can lock in that 4.5% income at this point, but not go too far out on the duration curve. So the 10-year, an area we think can stay very volatile, especially after the election, because of all of the fiscal discussions that will take up all of next year.
How's your view on Japan right now? Obviously, the yen carry unwound, but now the yen is weakening again, almost 150.
Yeah, so I think in the very short term, the enthusiasm around Japanese equities have taken a pause. We saw that since early August when we first started getting that very rapid appreciation of the yen and the unwind of the carry trade. But that's one area where we have conviction. There's a rebuild of strategic allocation again to Japanese equities. We've been talking so much to our clients in the U.S., Latin America, Europe about this, and really all about the corporate governance reforms, and really a generational re-rating in Japanese equities. What was a sideways market for 30 years, now at the start of a new bull market. I just think it's going to go through phases, right? In the early part, it's all about exporters, the lower quality, the higher multiple expansion, the better. I think the next step is more focused on domestic demand and quality value companies.
Is that and just to bring in the China part again, is that an either-or question for investors looking at Asia? I mean, is I mean, has Japan done well because China hasn't? Has India done well because China hasn't? You know, has that? How do we look at that from a zero sum? Do we look at it from a zero sum perspective?
I think that's a great question, and we actually were looking at these ETF flows last week to get a gauge, right? Have that $12.7 billion into Chinese ETFs? Has that meant it's gone out from other markets? And the answer so far is no. They just kind of flattened out, with the exception of Japan, which has seen some outflows since the carry trade. But I think from here, it's all going to depend on the level of enthusiasm for the China trade and the perspective of how much China's size is set to grow or not in global indices again. We really continue to see the interest in building up strategic allocations much more in Japan, and then within emerging markets in India, where flows have just leveled out at a very strong $8 billion so far this year.
Gabriela, it was nice to see you. Let's do this again next time you're in town. Have a great rest of your trip. And week ahead, Gabriela Santos, their Chief Market Strategist for the Americas at JPMorgan Asset Management. Going into the open today, just under 8 minutes away, we're looking at declines 70 points. Not a lot here on the Hang Seng Index. A preview of the trading session just ahead. This is Bloomberg. Welcome back. A look at your agenda for today here. So day 2 is a question mark for the rally. Early going suggests that we're going to open up with some weakness. Keep in mind, of course, we had a massive rally on Friday towards the afternoon session. And within that rally, it was really the outperformance in small caps, and some of the benchmarks are up 10 to 12%. We'll look at those once things open up in about 5 minutes from now. Gold miners on the back of spot gold hitting a new record today. And of course, we're going into the earnings conversation with Ping An, ZT, and China Mobile among the big names set to report earnings today. We're looking at the open and some of the moves in the pre-markets right now. So we're looking at declines in the Hang Seng Index, 70, 80 points, give or take. Dollar China, of course, the fixed non-event there. As far as analyst actions go, so a lot coming through here. Can we flip the boards, please, and look at analyst actions? So not a listing in Hong Kong, but certainly something to watch given the sort of macro headwinds out there. Next page, please, not this one, the next page. Thank you. Is this note on Richemont coming out, I think it was Goldman Sachs, warning about, and keep in mind the LVMH story on the weakness in China so far. Goldman Sachs cutting that stock to neutral on the back of this tough macro backdrop, Steve. Demand for luxury.
Obviously, I mean, the big ticket items are not going out the stores, off the shelves right now. They're still kind of waiting. Yes, the stimulus has definitely helped, but there's not been much actual targeted stimulus for the consumer. Xi Jinping is,
that's right.
He's not a fan of welfareism, cash handouts for people to go buy luxury handbags, right? So it's going to be a bit of a tough going for the luxury makers still in China.
It'll take time, right, for consumer confidence to come back. And it's hard to measure, too. Consumer confidence, I guess, if you think about it.
You can see it, and you can feel it in the shopping malls of my trips to Shanghai and Beijing. They are not necessarily shopping the way they used to.
Okay, the open is next. This is Bloomberg. Welcome back. You're watching The China Show, counting down to the open of markets. It's a fresh trading week after, well, how I described it was a week and a half of soul searching. I think Steve put it much, much better than that.
Floor searching. Floor
searching, yeah. Did we find it?
Depends on where you're looking.
You've got to check Google for that. In terms of the price action we've seen, so it's a 31% rally from September 23 in the initial leg up. Then we went down about 10, 11%. And then I think on Friday, it takes us to about 17%. So we're still higher by 17%. The thing is, though, with the passage of time, do policymakers have enough in the tank to, I guess, in many ways, will this market higher while we wait for earnings and the economy to recover here?
Well, as we heard from Gabriela, looking for a number on the fiscal front.
Yeah,
right?
A big one.
A big one.
Or any number.
Yeah, any number. So we might have to wait till after the National People's Congress Standing Committee meeting, which is likely to come at the end of this month or early next month, and also get the U.S. election out of the way, and then they can prioritize policy depending on who's going to be in the White House.
Yeah, it's a preview of something that's ahead here on the China Show as well. This time, the next hour, Christopher Wood will be joining us, of course, big market guests. Just get your questions in. You know how to reach us as you look ahead to the earnings season as well, to look for fundamental reasons to structurally reallocate back into this market. Speaking of earnings, CATL 3.8%. That's an earnings story. Shanghai Comp is up 0.4%. A look across sector groups right now. Most are higher. We're looking at brokers and also small caps on the back of what we saw on Friday. Flip the boards, please. Have a look at Hong Kong. And I think we were down last week almost every single day, with the exception of Friday, of course. And that was enough, actually, to see us, at least on a momentum basis, bounce off that 50 handle on the 14-day RSI on Hang Seng China. Index weakness across your screens. We're looking at some earnings coming through out of Ping An, ZTE, and China Mobile today. Brushing off the broad weakness is small caps, at least broadly speaking, of course. So large cap index is number 1 on your screens. You have the Starboard number 2, Chinex, and the Beijing 50, which actually should be up. This looks to be the closing price on Friday of 10%, so we'll let it get warmed up a little bit more. The gold price, of course, is very much in focus today. Spot and futures are up, and as you can see, and Zijin Mining, by the way, is an earnings story, reminding us on Friday how good their earnings have been because of gold prices moving up. Moving against the grain, as you can see here, up to 2-3% ahead of a very busy week, Steve.
Very busy week for IPOs. Investors will be closely watching the new issuances across Asia this week. It's the busiest week of listings for regional stock markets in more than 2 years. It poses a crucial test of demand ahead of the U.S. election. Let's bring in Bloomberg Asia Equity Capital Markets reporter Giulia Fioretti. Giulia, it is a big week. There's a couple of smaller ones here in Hong Kong, but the big ones in India as well as Japan. What really should we be looking out for as far as investor appetite for these listings?
Well, as you say, it's a crucial week and it's an extremely busy week. And part of the reason for that is that we're obviously a couple of weeks away from the U.S. election. So issuers are trying to catch the window before that. They seek to avoid periods of market uncertainty and volatility, and obviously elections can bring that. So that's part of the reason we're seeing this big rush. And in terms of what we should be looking out for, obviously Hyundai is a huge test for India. It's India's biggest IPO on record. The Indian market has been extremely busy over the last few years, but these have mostly been smaller listings. So this will obviously be a test that the market can absorb such a huge deal.
$3.3 billion.
Yes, it's extremely big. And the retail participation wasn't quite as strong as some had hoped. The institutional one was. So that will be a key test to see whether more chunky listings can follow after this. And we've also got Tokyo Metro in Japan later in the week. That's obviously the biggest listing in 6 years, I believe. And that one did extremely well. There were lots of incentives for retail investors. But it's also a test that more big Tokyo IPOs to come.
And some of the listings here, like China Resources Beverage, Horizon Robotics, I guess, as an acid test, whether, animal spirits are back in this market. Can it continue, I guess? The number of listings, what does the pipeline look like? And what do you think the day of trading will tell us about sentiment right now, whether it's back or not?
So whether it will continue, obviously, partly depends on how they do. If these IPOs do well, then obviously that's a good sign. Then you've still got this event of the US election, and it's hard to say if there's a lot of uncertainty after that, there might be a pause. Certainly, IPOs are getting ready, companies are getting ready to do their IPOs, both in Hong Kong and elsewhere. And so they will probably try to continue unless there's extreme volatility. But essentially, it does come down to whether these large deals, especially the ones you mentioned in Hong Kong, which, unlike Midea, they were not already listed. So they're quite a test of investors' appetite for completely new companies that they're not already familiar with. If they do well, certainly more will follow.
Okay, and let's hope it's the latter, of course. Giulia, thank you so much. Giulia Fioretti there, our Asia Equity Capital Markets reporter. So we were just talking about $8 billion there, the amount that was raised, when you look at these listings, 8 billion seems to be the magic number for this week, right? So it's 8 billion, of course, also, well, 8 trillion in market cap. Let's add a couple of zeros to that. As far as the earnings season goes, so a preview of the week ahead in terms of market cap on the S&P. So the amount of companies reporting this week have a total of about 8 trillion market cap. So it's a relatively big week, not as big as next week, but I guess we can save that for a conversation in 7 days. Although some of the other names reporting, Tesla, Texas Instruments, Boeing, among the big names reporting, of course, in the U.S. and here in the region, we have the likes that we talked about in the China context. You have Ping An, SK Hynix in South Korea, along with LG Electronics, and Apple supplier Luxshare is also set to give us its report card.
A lot of tech on focus. Yeah. Obviously, Horizon Robotics is an interesting one, Dave, because it is backed by Alibaba and Baidu, kind of a return of those big platform companies in China backing new entrants into the market. So it's a small listing relatively compared to the Horizon, the Hyundai India as well as Tokyo Metro, but still one to watch out for. Horizon Robotics begins trade later this week. All right, let's bring in our tech reporter, Annabelle Drewlers in Sydney. Annabelle, I know you're not here to talk about Horizon Robotics, but what is standing out to you on the tech earnings front across Asia?
Steve, I'll definitely talk to you about Horizon later this week when it starts to trade. That is a big listing for Hong Kong and certainly one to watch in the tech space. But on the earnings front, there's other names, of course, that are in the headlines for us. And one of those is going to be Tokyo Electron. And I think it's really important to reflect on this name just in the context of what we had last week, because, of course, ASML sent all those jitters through the markets when it sort of indicated really that two-speed recovery we're seeing in the semiconductor space. On the one hand, you've got all of that brightness around AI chips, but legacy ones are still suffering. And that could perhaps be a theme we see across the course of this week with SK Hynix, another name that is reporting. But Tokyo Electron actually could have done really well in the first half of the year. Especially as it continues to make those sales to China. You can see here what they did last year, around $5.6 billion going to mainland China. It will be interesting, though, of course, if the company reports at all or makes any mention of the pressure that's being put on it by the US, because over the weekend we had reporting as well that US lawmakers had written a letter to the Japanese ambassador in the US, essentially citing Tokyo Electron's share price, among others, but making the point that the restrictions that are already in place in terms of exporting the most advanced chip-making gear to China are not having the intended effect so far.
Okay, Belle, you mentioned SK Hynix. Give us some context here on these numbers.
Well, I think for SK Hynix, it's really going to be that story around HBM, and high bandwidth memory chips are a key part of AI infrastructure. And we know, and we've spoken so much about that sort of lead that SK Hynix is making in this space over the likes of Samsung. So this could again play out in the numbers here. We do have the third quarter figures coming through, and our Bloomberg intelligence team is saying we're going to see really robust demand for those products. That could help as well lift its margins. We're really focusing on those more high value pieces that it brings to market. On the flip side, of course, you've got products like DRAM, for instance, and this is really talking about the demand for chips that are used in things like smartphones, PCs. That could be weaker, but again, offset by the strength of the part that plays into AI.
All right, Bloomberg tech reporter Annabelle Drewlers joining us from Sydney. Thanks so much.
Yeah, okay. Market-wise, we're looking at a 10 to 1% to the downside right now. MSCI China down about 0.5%. So a little bit of weakness coming through, which is largely, I guess, in many ways expected given the rally that we had, of course, on Friday.
All right.
Yeah.
I think we'll be right back, right?
Yeah, in a couple of minutes. Well, hopefully, don't go away.
Oh, yeah, it's our exclusive interview with Taiwan's premier, who talks about how the island is seeking to build on its strength in the semiconductor industry. There's Matt Winkler with the premier of Taiwan. We'll be right back. This is Bloomberg. And welcome back to the China Show. Here are some of the big corporate stories we are following. Shenzhen-based drone maker DJI has sued the U.S. Department of Defense for adding it to a list of Chinese military companies. DJI says after months of unsuccessfully attempting to engage with the Defense Department, it had no alternative but to turn to the federal court. The world's largest maker of consumer drones was first added to the list in 2022. And Apple's newest iPhones are seeing a strong debut in China. According to Counterpoint Research data, sales of the iPhone 16 are up 20% in their first 3 weeks compared with the prior model. Consumers are also continuing to shift to the pricier versions. Sales of the top-end Pro and Pro Max models gaining 44% compared to last year's equivalents.
Now, Taiwan's premier says that the island's government is open to the latest nuclear technology to meet its surging power demand coming from, of course, its whole list of chip makers. Zhuo Rongtai also told us about how Taiwan aims to diversify its economy beyond just its lucrative high-tech sector.
Taiwan's economic resiliency comes from the partnership we have with friendly countries. Domestically, we have a strong, vertically integrated supply chain. This is why we believe Taiwan can play a crucial role in the democratic supply chain. We are heavily reliant on high-tech industries, especially in the rapidly developing semiconductor sector. However, for Taiwan's economy to achieve comprehensive growth, we cannot rely solely on high-tech industries. That's why we proposed a dual-axis transformation for small and medium-sized enterprises. We aim to help our traditional industries and small to medium-sized enterprises enter the AI era. We will use government resources to assist them in adopting AI applications and integrating with this industry, allowing Taiwan's economy to grow comprehensively.
So, Mr. Premier, the U.S. is going to have an election, a presidential election. It's just weeks away. Former President Trump previously said that Taiwan took chip business from the U.S. and asked Taiwan to pay protection fees. And do you think Taiwan should continue to allow semiconductor manufacturers to, like TSMC, to build factories overseas?
Taiwan also needs to rely on advanced countries for new technologies in materials and equipment. I often say that the government has a responsibility to Taiwan's industries, and Taiwan has a responsibility to the world.
Mr. Trump also said Taiwan should increase military spending to 10% of gross domestic product. And I wonder if that's possible in your view.
Taiwan has a very large neighbor with significant ambitions toward it, so Taiwan must take responsibility for safeguarding our sovereignty and national security. In next year's central government budget, we have allocated more than 640 billion Taiwan dollars for defense. This will bring our defense spending to approximately 2.4 to 2.6% of GDP. While we cannot allocate 10% of GDP to defense in one go, we have increased the budget compared to the past. We also hope that through Taiwan's efforts, the world will recognize Taiwan's determination and provide greater support. What we're maintaining is not only Taiwan's security, but also the peace and stability of the entire Indo-Pacific region.
You mentioned artificial intelligence earlier in this discussion, and given the importance of AI and how fast it is expanding, there is a debate about electricity supply. And I'm just wondering, do you think sort of new nuclear power technology is something, an option, say, for Taiwan that you could consider?
We know that many other countries are actively developing various forms of nuclear energy. Currently, we expect that Taiwan will have no issues with power supply for industries before 2030. Our nuclear power plants are being decommissioned and operations are stopping. This is because we need to prepare for future nuclear technology developments and to respond to any potential legal changes in Taiwan. When we take the next step forward and reconsider the existing nuclear power plants, we will need sufficient manpower. So even though our plants are being decommissioned, the personnel must not be dispersed. They must remain to address new technologies or solve current issues.
That is Taiwan Premier Zhou Rongtai speaking with Bloomberg's editor-in-chief emeritus, Matt Winkler. And if you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function, TV Go. You can also join the conversation by sending instant messages to our team and our guests during our live shows. Nice comments only, please. Check it out.
If you don't like my tie, save that for yourself.
Check it out at TV Go. Again, be nice. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Welcome back. You're watching The China Show, and as you just saw that little teaser there, we have a programming note. We have a new program launching today called Insight with Haslinda Amin. That's at 11 a.m. Hong Kong and Singapore time. And Haslinda now joins us to tell us more on what to expect. Tell us about your guests and the show.
Well, for a start, Steve, I want to put it out there. I'm having butterflies, lots of butterflies. It is a big day for the team. Months of preparation, months of brainstorming, months perhaps of sleepless nights thinking of, how we should put it across to our viewers. Really, this is a platform to delve deeper into stories that matter to investors. We want to go beyond the headlines. We want to provide the context. Remember, within the space of Bloomberg, context changes everything. And you know what? We want to go beyond financials. We want to go into all aspects, all sectors, which are important to our viewers, like AI, like technology, like climate. So we're tapping the expertise of the top names out there, policymakers, newsmakers, that move the needle. So it will be conversations that matter. You talk about who's coming up. Well, big names are coming up. We're talking about Carson Block. You know this name very well, Steve. I mean, he's known as the king of short selling. He's been shorting Chinese companies since 2011, the likes of Sino-Forest, Luckin Coffee. We want to talk to him about whether or not he thinks, China is investable right now. And if he doesn't think so, what would change his mind? We also have the likes of the IEA chief. We've been talking about the escalating tensions in the Middle East. Yet when you take a look at oil, it's still below $70 a barrel. What's going on? What's happening with demand? What's happening with supply? And what's shaping all of that? And you know what? Bring in AI, bring in data centers, how they're consuming, sucking a lot of energy. How will that shape the energy landscape? So lots of conversations going on. You want to, be clued in. Join us at 11.
Oh, absolutely. We'll let you go for now, about 60 minutes or so to the start, of course, of the new program coming through for our viewers. Of course, do not miss that coming up at the top of the 11 hours. You're watching out of Hong Kong, Beijing, and Singapore. Right, just for a brief look at markets right now, we're looking at, it feels like a Sunday, if you think about it, on a benchmark basis. A couple of movers, though, to maybe wake us up. So Sinopharm, so this is a TCM buyout bid that actually lapsed without getting, at least currently, getting the approval from regulators. And as you can see, of course, the stock is tanking 35% in the early goings. Of course, when you get news, of course, of a potential buyout or merger, you do tend to see the stock try and race toward that, whatever the offer price is, if that information is available. That seems to be the opposite right now. Of course, 35% down. To the downside. CATL, that's an earnings story that is going the opposite way. That is, I guess, in many, many ways because of how heavily weighted the stock is across most Chinese benchmarks. It's keeping this market honest. We're up 3% as far as that's concerned. Third quarter core earnings actually beating analyst estimates. That's number one. Number two is, I think when you look at, we have a lot of time remaining. Okay, what do we talk about? Let's talk about some of the earnings coming through this week. So you have Ping An coming out with earnings. You have the likes of, and I think as a side note on Ping An, what so far, if you had to pick one in my opinion, one clear sector winner from this rally, and where it's really showed up in earnings and earnings guidance so far, it's really in insurers, right? Because they're sitting on, I guess, if you mark to market, they're sitting on a lot of equities and on their books, and that is almost, depending on which, I guess, insurer you're talking to, almost an instant pop. Do we have insurers up? Or at least a graphic that shows, thank you so much, here we go. An almost instant re-rating on some of those equity holdings, that they're sitting on. So I guess guidance out of Ping An will be very important, apart from, of course, the core business that we're looking at there as well. Apart from a programming note, we're just getting this in our inboxes right now. UBS, because of the GDP print last week, has just come out and talked about this upgrade to Chinese growth. So they have bumped up their forecast for 2024 and 2025 to 4.8% and 4.5% respectively. So let me just read out that note here from Wang Tao, the chief China economist there. In light of the stronger than expected 3Q GDP numbers and recently the policy push, we now see Q&Q GDP accelerating to 6.5%. That's a seasonally adjusted rate in Q4. Though on a year-on-year it's 4.6. Okay, I'm going to go into much today. As a result, okay, bear with me here. We now expect nominal GDP growth at 4.5% real GDP growth for 2025. So we're starting to look ahead to next year, Steve.
Yeah, I think we are looking to next year because, again, depending on that number that we get for fiscal stimulus, if we do, in fact, get, that big number that many are hoping for, the fiscal package and the implementation of property and other easing measures may bring upside risks to her 2025 growth outlook. But, again, there's also the possibility of a Trump presidency. She doesn't mention Trump, but she says the prospect of rising tariffs could also see growth to below 4%, even with a bigger policy stimulus. So those tariff increases could be a big risk.
Yeah, it's really the story for next year because I get to your point, right? On the elections, any incremental change in tariffs will really get felt in 2025. Right, going into the next hour of the China Show, we have a conversation around a potential meeting between President Xi and Narendra Modi at the BRICS Summit taking place this week. And of course, Christopher Wood joins us to talk all things markets. Stay tuned for that. This is Bloomberg. Welcome to the second hour of the China Show, a live view of the financial district, of course, in Shanghai. That's the Pearl TV Tower, Dongfang Mingzhu, view out of our offices there in Lujiazui. We're looking at declines here in the H-share market of about 1.3%. We saw a rally 3-4% on Friday. Hang Seng Index 1.1% to the upside, to the downside rather. 20,589. I think if you like nice round numbers, 4,000 on the CSI 300 is one to watch, of course, as we attempted to scale that specific line on Friday. Very quickly have a look at where we are as far as the sector movers are concerned. IMAP is a function. You run that on an index. This is what you get on your screens. And mostly, as you can see, declines across various sector groups with the exception of a few pockets of green here, IT. And one which I'm not too sure what that is. Well, I mean, that being said, right, so we are seeing at least some questions remain. What's next? It's not clear what the next catalysts are really for this Chinese market. It seems that we're still trading on headline risk and, the news of a briefing. Then we get our hopes and expectations up. Markets respond, and then markets then start to linger and wait for the next one, Steve.
Well, let's put that question to Mark Cranfield, Bloomberg MLive strategist. Mark joins us now from Singapore. So David just spelled it out. How are the animal spirits, if you will, in the mainland markets going to maintain their momentum without the catalyst of a big figure stimulus package and with the prospect of a Trump presidency obviously coming and bringing new tariffs that Wang Tao at UBS says is the big risk for 2025?
Yeah, it's not easy to sustain the confidence in the markets, even though we saw a very good rebound on Friday, particularly with the help of the PBOC. Clearly, from an investor's point of view, it's Chinese central bank who have the credibility, and whenever they come in with one of their measures to stimulate things and to improve sentiment. People really take notice. That was the big reaction we saw on Friday. And the markets are probably having a little bit of trouble digesting what was a pretty decent move at the end of last week. And there's a lot of money has been built up into the market. You can see it in the margin trading accounts. The balances are pretty close to record highs in there. So there's a lot of hot money sloshing around. And this needs constant momentum. You need things to fuel the moves on a regular basis. Otherwise, people get tired and they start moving their money out of the market. And as you said, there's a number of things coming up in the near term, not to mention the least of which is the US election. And people will be a little bit uncertain about that. But we did get a slightly bigger cut in the loan prime rate this morning than people are expecting, 25 more than 20 basis points. So that was encouraging. But with so much attention and so many people involved in this market, you will need a gradual increase in that. People just need the momentum to keep them going forward. There will need to be incremental factors to help them. But a period of consolidation is also a healthy one for the Chinese markets, and it seems to be at a higher level than we were. Most of that big rebound we've seen since September is being held, but it's going to be a very nervous period as you come towards the US election, and people are losing patience as well. They want to see immediate results in China, which isn't going to happen because the stimulus programs are things that will play out over months, maybe even a period of a couple of years, but people want to see the results straight away. So you have this disconnect between what equity punters want and what the government is willing to deliver, and it will take time to play out. But the underlying factors certainly have improved to the positive side for China. Let's see whether or not investors can actually stay in and not lose faith in what the PBOC and what the government is putting into place.
Yeah, Mark, and Christopher Wood out of CLSA will be joining us. That's really a good question, I think, to ask him. Thank you so much for that suggestion. I mean, what is appropriate exposure to China while we wait for the other things to respond? Mark, just on a separate note, you mentioned the elections coming through. What are the hedges right now? And the reason I ask you that is, gold seems to be a place that people prefer to park their money at the moment. Can't stop rallying gold. What's going on there?
That seems to be a no-lose situation, doesn't it? It seems to be central banks are involved, short-term traders are involved. Everybody seems to think that gold is the ideal haven, particularly in the background. You've got some geopolitical tension still in the Middle East. It obviously helps from that point of view. But the fact that real money flows are going back into it because they see it as it's a cleaner play than even currencies or bonds or anything else. If you look at in the currency space, there are trades going on where people think that the election process will favor. At the moment, people seem to think that Donald Trump has a slight edge. That's favoring the US dollar, especially against things like the Mexican peso. The Chinese currency, to some extent, is losing out there. But it's a mixed picture within the dollar world, because on the flip side, you've got the euro very much on the weak side because the European Central Bank is pushing rates lower than people expected. So it's not a clear win there. The other one, of course, is cryptocurrencies. Bitcoin is doing extremely well again because people think that Donald Trump might slightly favor cryptos if he does get in. It can all change very quickly. If we see the polls in the US start to swing towards Kamala Harris, a number of these things will start to unwind. But most people's attention span in markets at the moment, especially in things like cryptos and gold, is pretty short. So anything over the next 48 hours, they're very keen to jump on board of it. Beyond that, they're not willing to make too much of a bet. So you'll see this kind of choppy, erratic trading continue right through for the next couple of weeks until we see what actually happens in the US election.
Okay, yeah, I have to correct myself, and this is going to be embarrassing because Christopher Wood was at CLSA. He is at Jefferies right now. Okay, I get loosed in my history sometimes. Mark, just very quickly, I mean, I'm looking at oil markets. Your question of the day out of your team is how long before crude oil makes these fresh lows. Is that a question that you think we should be asking given the simmering tensions and really what took place on the weekend between Israel and Iran?
What people are trying to figure out here is how much of a risk premium should they input into oil for these tensions between Israel and other people in the Middle East. And it's not easy to quantify, of course. At one stage, particularly, say, for example, when Russia invaded Ukraine, it seemed pretty obvious that there was a risk premium of something like $15 to $20 on the oil price just for that dislocation that was happening there. It seems to have shrunk a lot. And the more that we have a situation where Israel and Iran don't engage directly with each other, that premium seems to be dropping and dropping. It may be down to something like $5 by now, but that is really what is challenging the people in the oil market at the moment. Supply is reasonable, the risk premium is falling, and now people are trying to figure out where is a real stabilizing price for this. And it might well be below $70. It could be in the low 60s before we get to that kind of point, unless there's an unexpected flare up back in the Middle East. So that premium is really what people are playing for, and it seems to have fallen quite a lot these days.
Mark, good stuff. That's Bloomberg's MLive strategist, Mark Cranfield. All right, still ahead on the China show, we asked Jefferies why they've cut their overweight position on India while boosting their China bets.
Yeah, but ahead of that, BRICS members are set to meet in Russia, of course, which holds the chairmanship of this week's upcoming meeting. Predictions on expanded grouping could actually double the GDP of G7 nations of 2037 if we do see, of course, this expanded group. BRICS Plus. Closer look at the agenda. Next, this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Welcome back. You're watching the China Show. This is China Decoded, where we take a deep dive into the Chinese economy, politics, and foreign policy. Well, BRICS members are preparing to meet in the Russian city of Kazan on Tuesday, their first gathering since the group expanded in January. But much of the focus is on China and India. Analysts are looking for signs of a potential meeting between President Xi Jinping and Prime Minister Narendra Modi. Relations between the two have worsened since they last met on the sidelines of a BRICS summit in 2023. Now, the nuclear-armed neighbors have had thousands of troops facing off in a disputed region of the Himalayas since a border conflict erupted in 2020. The dispute sparked the worst armed clashes in 4 decades, with over a dozen soldiers killed. Both Xi and Modi have agreed to intensify efforts to de-escalate tensions, but multiple rounds of talks have made little progress in resolving the standoff.
Now, let's also go beyond some of the territorial disputes, which obviously will be front and center as well. But you look at things like the two countries disagree when it comes to trade, for example. So in July, New Delhi ruled out the prospect of joining the Beijing-led RCEP trade deal, saying it was not in India's best interest. Now, trade between the two reached a record of just under $120 billion last year. That's only marginally higher than back in 2022. Although that's up certainly more than 60% if you take the scale back over the last, say, 10 years or so. Now, but Beijing has lost its long-standing position as India's biggest trading partner. In fact, for the 3 years of the last 5, the top spot has been occupied by the U.S. Now, BRICS has gone from a slogan dreamed up at an investment bank 2 decades back to a real-world club that controls a multilateral lender. Our Asia government and economy correspondent Rebecca Chung-Wilkins is here with us to give us, I guess, some real context on this week's meeting. Yeah, and Rebecca, what can we and should we expect from this week's gathering?
Well, you flicked at this a little bit already, David, but this question of the expansion of BRICS is really front of mind. We saw that with the addition of new countries earlier this year, Middle Eastern nations, Ethiopia as well, and there are still other nations that are potentially seeking to be added, Malaysia, Thailand, Turkey, for instance. And there has been this sort of quite fundamental debate or divide within BRICS over whether or not to expand. So China, for its part, has really been pushing the expansion of BRICS. And other nations have been somewhat more cautious. So India, as you mentioned, for example, is concerned that if BRICS does expand, essentially it could become a mouthpiece for China. Brazil, for its part, is also cautious that if BRICS expands and it sort of plays into this idea of a multipolar world, an organization that can kind of counterbalance the US sort of hegemonic world order, as Beijing often likes to call it, it might alienate Western countries. So there hasn't been sort of unilateral support for the expansion of BRICS, which is why it's really still very much in focus.
And Rebecca, so obviously, how significant of influence could BRICS have if they add the 10 members that are actually in the queue to join? And there are 35 other nations who are essentially expressing interest. I mean, a lot of the global south are supposed to be non-aligned. And it gets to the point that you just made about they don't necessarily want to be in a grouping that is just propelling the interests of Xi Jinping and Vladimir Putin on the geopolitical front. They'd like the economic benefits. So, I mean, does a larger BRICS really carry a lot more geopolitical influence?
Well, I think it depends on who we're talking about when it comes to sort of asking this question of geopolitical influence. Like, does it benefit Beijing, for instance, to be somewhat at the forefront or a somewhat dominant power, economically speaking and geopolitically speaking, of a cohort of countries that is much heftier in size? I mean, we could see basically the BRICS sort of cohort more than double since its sort of innovation 2 decades ago. But of course, with a bigger group, you know, there are more of these debates. There is more sort of diversity among those voices. And there is a question to which perhaps countries will have to be a bit more cautious. The sort of location of BRICS this year, of course, in Russia, underscores some of these sort of fundamental fractures that some of those nations might be cautious about if it comes to sort of being seen as too heavily throwing their weight behind China, throwing their weight behind Russia. That certainly is sort of one potential weak point. And indeed, for Beijing, has been this sort of constant sticking point and constant source of criticism from Western nations, from the US and from Europe.
All right, Bloomberg's Asia government and economy correspondent Rebecca Chong-Wilkins, thanks so much for joining us. Let's bring in Sreeradha, Datta, Jindal School of International Affairs professor at OP Jindal Global University. Thanks so much for joining us. We just probably heard our correspondent there, Rebecca, talking about the challenges and the opportunities faced by BRICS as it weighs whether to expand even further. How important, obviously, this is probably the most obvious question I'm going to ask today, is it for, say, Xi Jinping and Narendra Modi to really meet face-to-face and maybe resolve some of their differences?
Hi, thanks. Yes, of course, apart from the summit meeting itself, which is going to talk about the expansion and the other modalities, the two of them meeting and resolving the crisis, I mean, the border crisis, the hostilities, I think that's something that they have, there's been some work which has been done in the previous weeks. So hopefully that there would be some kind of a bilateral meeting which would, you know, ensure that there's peace and stability, especially in the Eastern Ladakh region where we've seen a lot of aggression and hostility from the Chinese side. So that is the most positive outcome that we look at, disengagement of the military troops on both sides. I think that's the core here. And of course, there are many other things. It's a very strong economic partnership that's even growing even now. So there are many other common issues, but first and foremost, I think the security parameters should be in place and disengagement and peace on the border. That's the core for the bilateral.
Oh yeah, Professor, I was going to ask you that too. Do you think we will get more progress, at least in stabilizing the situation there at the border?
We are hoping so, because as you know, Indian troops have always only responded to the aggression from China. It has never been any untoward move from India ever. So we hope that there will be, serious talks about the disengagement. And over the last few years, we've attempted several times that, there has been some talks. We've not seen much progress, but whatever reports we've seen in the last 2 weeks or so, there has been some level of talks where there has been progress on it. And I think both sides have reiterated the fact that they want peace and stability at the border. And that can only happen when you're disengaging the troops. So we do hope that this particular bilateral meeting, there will be some focus on that.
How do you see the dynamic between, India and China playing out in the BRICS? Obviously, they have strategic differences, no doubt. But do you see this as an opportunity to have, at least some common ground economically between the two nations, even though they differ, and India is supposedly more non-aligned on the geopolitical struggle between the West and East?
If you're referring to the expansion or even BRICS, India's presence as BRICS, I think it's been a fruitful engagement because we've seen in the past, especially in the last half a decade, there has been several constructive initiatives and projects. While there has been a tendency for many to view this as a kind of a Chinese bloc, I don't think that's really how India perceives it. And while India works very closely with the Western powers, including US, who's a close ally, India is also working very closely. And I think that's not the issue that probably the summit is going to take up in terms of the modalities of introduction of new members. And, I don't think it's in anybody's case that it should look like a anti-India or pro-China bloc. So I'm sure in terms of the new engagement, which of course adds a lot of economic weight and strength to this particular grouping, and it's certainly a very important geostrategic, given the energy and the oil trade in terms of the member organizations. But at the same time, it should be a group which works together to benefit the populations and all of the group members, and it can't be seen or should never be seen or perceived as any anti-India particular group. And India, I think, is on strong grounds here. The bilateral differences are known to all, but at the same time, India is very clear at how it's able to mark its presence in a multilateral space. These mini-laterals are very, very constructively organized these days. So I'm confident that this particular grouping, even in its expanded space, would actually be beneficial for all the countries together.
Professor, final question. A lot of this is also reading between the lines. I mean, it's the optics, it's how we interpret the optics. And my understanding is, while the two leaders have met on the sidelines of several meetings, they haven't had a formal bilat, I believe, in at least 4 years. If we do get a formal bilateral meeting between the two, how significant do you think we should be reading into that, any potential meeting of that sort?
It is certainly significant. We've heard that India has set up bilateral meetings with the other members too. We don't know about this particular meeting, but I think you mentioned that they have met. They've only met twice over since the hostility began 2020 May onwards. So, and those were very brief meetings. They were not anything which was constructive in terms of discussion platform. Hopefully this time around, as I mentioned just previously, that there will be, because we've just seen a bit of background work being done on ensuring that there's a kind of a process of disengagement from the military sides, for both the sides can begin. So I think with that background, we are hoping that the bilateral meeting here would be certainly far more constructive than what we've seen in the past two meetings.
Sreeradha, Datta there. Thank you so much for the time. Professor, Jindal School of International Affairs, professor at the OP Jindal Global University. Right, about 51 minutes and 45 seconds to be exact, seconds into the cash market session here. Hong Kong markets are down about 0.6%. You are catching a bid, though, as far as onshore markets go, 0.3%. And we're headed into the lunch break in Tokyo, so a full roundup of the big movers across these equity markets just ahead. This is the China Show.
And welcome back. You're watching the China Show here on Bloomberg. Here are some of the top stories we're following from around the world. Israeli Prime Minister Benjamin Netanyahu has met with top security aides to discuss an attack on Iran. It comes after a Hezbollah drone penetrated air defenses on Saturday and exploded next to Netanyahu's private residence. Israel, meanwhile, has launched a military operation targeting Hezbollah economic strongholds in Lebanon. A particular target is a financial institution used by the Iran-backed militant group and its leadership. Well, Shenzhen-based drone maker DJI has sued the U.S. Department of Defense for adding it to a list of Chinese military companies. DJI says after months of unsuccessfully attempting to engage with the Defense Department, it had no alternative but to turn to the federal court. The world's largest maker of consumer drones was first added to the list in 2022. And Apple's newest iPhones are seeing a strong debut in China. According to Counterpoint Research data, sales of the iPhone 16 are up 20% in their first 3 weeks compared with the prior model. Consumers are also continuing to shift to the pricier versions. Sales of the top-end Pro and Pro Max models gaining 44% compared to last year's equivalents.
Okay, let's have a look at some movers across these Chinese markets. CATL earnings story there. We're up still 2%. We're slightly off highs of the day that we were, I think, up as much as 3.5%. In the early minutes, this is an earnings story. It was out on Friday. Better than expected, 13 billion 3Q net income. That actually missed. Sorry, let me just correct. That actually missed. But as far as the core earnings go, that actually came in slightly above expectations there. China TCM, Traditional Medicine Holdings here, the stock is down as this buyout bid lapses without getting the regulatory nod. We're down 35% as far as the stock goes. So that's the latest on what was, well, I guess still is a potential deal. Watch for developments here. And solar stocks, about an hour into the session here, so almost a consistent gain across some of the big movers here, and we're still trying to understand really what's going on. There has to do with some guidance coming through on pricing in the industry. We'll get to more in this story in a moment. Plenty more ahead here on the China Show. All right, welcome back. So we're going into the Japanese lunch break, and well, I mean, I was going to say 150 on dollar yen. That was a milestone we hit, and as you can see, we pulled back from that level. Broadly speaking, though, when you look at the currency markets today, I mean, the dollar's up, 3 straight weeks, right? This repricing around, can the Fed cut by another 50? Can it even cut at all at the next meeting? I think we can get into the weeds of that a bit later on. But certainly this repricing we've seen in the currency markets, yields have picked up, 4%, of course. On that, that's a conversation there. Nikkei 225, they're 39.2, 0.4% there. The 10-year yield in Japan is, there we go, inching ever closer. Again, back to this 1% handle on the 10-year yield. Asia Pacific, because of Japan, because of parts of the onshore market in China, Australia is also a big mover here. 0.3% to the upside. The big mover, though, not on your screens right now, is really away from the equity markets, is really what's taking place in the likes of gold, for example, is a story that we've been talking about here with spot and futures hitting new records this Monday morning, and you're seeing that play out really in the equity markets as far as that group of stocks is concerned. In case you missed it, so UBS just dropped this note in our inboxes about 30 minutes back, and because of the GDP print we got last week, they've actually bumped up their forecast for Chinese growth this year and next year, Steve. Yeah, that's right. And also just throwing out, a caveat that the stimulus, that could be coming if we get a fiscal stimulus number could be a risk to the upside of that projection as well. But at the same time, it could be a downside risk given a change, if you will, and there will be a change in the White House, regardless of whether it's Kamala Harris or Donald Trump. But if there's a specter of rising tariffs on Chinese companies and products sold to the United States, that is a downside risk to their outlook. Yeah, that's going to be a very busy 24 hours, really, because you do get the elections, and then you have the Fed meeting as well coming up around the same time. And certainly the conversation, we've had this early on the Chinese story, right? I mean, the markets rallied 31%, pulled back 12%, gained 3% on Friday. We're still up 17% from the bottom on MSCI China. And the question right now, as you move into earnings season, is it too early to expect corporates to start reflecting better guidance? When do earnings bottom? When does the economy bottom? When does the property market bottom, right? So there's a time gap between the pronouncements we've heard and when those things start to respond. And I guess at some point investors will run impatient, given how quickly this market tends to run up.
We heard from Mark Cranfield. He said, can these Chinese stocks, keep the momentum up over these next critical 3 weeks between now and the U.S. election? And immediately on the heels of the election is the Fed's next meeting as well. So.
Well, and I mean, that's a good reminder, because when the Fed's cut by 50, immediately after that was the briefing out of the PBOC that started off this whole re-rating of the Chinese market, a reset, as some people would call it. Now, we put a question early on to our previous guest, Gabriela Santos, out of JPMorgan Asset Management. She's a strategist there. And we asked her whether the China conversation is starting to eat into allocations from dollar investors into the likes of India and also into Japan. Here's what she had to say on that very question.
But I think from here, it's all going to depend on the level of enthusiasm for the China trade and the perspective of how much China's size is set to grow or not in global indices again. We really continue to see the interest in building up strategic allocations much more in Japan, and then within emerging markets in India, where flows have just leveled out at a very strong 8 billion so far this year.
Joining us here on set to talk us through and give us more context is Christopher Wood. You might know him as the Global Head of Equity Strategy at Jefferies. It's nice to see you, and thank you for taking the time to come in.
Thank you. Good to see you guys.
Do you anticipate needing to make room for more China exposure by funding it through other EMs like India, for example? Where's your head as far as that's concerned?
Oh, yeah, well, tactically you had to increase China exposure when you saw the policy move, because clearly the easing moved beyond the incremental. But I was running China marginally underweight for most of the year. So in my short-term relative return portfolios, actually I was too weighted in China because it was just so cheap and the policy response was going to come. And I've been running India most of the year in that portfolio as a marginal overweight. But in my long-term greed and fear portfolio, which is just 25 stocks in Asia, I've still been running India nearly 50% and China 15%. So it really comes down to whether you've got a 5-year view or a 3-month view. But if you're a fund manager and your career depended on outperforming the Asian index any quarter this year, it was just way too risky to have 50% in India and 10-15 in China. But bottom line, best stock market in the world for the next 10 years remains India. And I would have said the same thing 10 years ago and 10 years before that. In fact, I have been saying the same thing.
But there's been the rotation into China because of the stimulus. How short-term is that if the fundamentals are still the same? There is a strong deleveraging campaign, and there is a slowing consumer sentiment in China. There are fundamental issues. There's a rising prospect of increased tariffs from Washington, also from Europe as well.
No, absolutely. So what I've been saying in China, the best thing to have done in China equities the last 3 or 4 years was simply to own the dividend index. If you would own the dividend index, you would have outperformed dramatically. My view has been that I've been telling people to invest in China bottom up in equities and to hedge that by owning the Chinese 10-year government bond. So the best way of hedging the deflationary risk, if you've got that ability, is to continue to own Chinese government bonds. But I would say once you had that move going beyond the incremental, personally, I believe there was a bit of a there has been a macro trade in China, and the all-important details are not yet announced, which we hope to get in the MPC. So it's crazy to be dogmatic about this. We need to see the details. But probably the most important thing is they are signaling a central government, local government debt swap, which I think is important. But my opinion, this is not going to be the Ben Bernanke style bazooka QE or Hank Paulson Chinese TARP equivalent, which obviously some people in the stock market are hoping for. And personally, I think that would be good for equities, but I think it would be negative for China, because that would undo all the years of deleveraging which they've been consciously pursuing. So the property downturn was intended, but the problem is that the lockdowns in, I think, 22 made the whole downturn in the property market much worse than it needed to be. Hopefully, though, they can stabilize the property market here. But as I say, hopefully.
Yeah, and to your point, right, it's we have to stay away from being dogmatic, and I think pragmatism, I guess, is perhaps the other side of the spectrum. So over the short term, we don't know where this market is going to go. Longer term, to your point, India seems to be your overweight. What do you think is appropriate China exposure, even if it is, of course, a minority part of your portfolio?
I've added a couple more China stocks in my long-only portfolio in the last few weeks.
And that's driven by what? Is that a valuation play? Is that a catalyst?
Well, no, because the valuations in China at the bottom discounted the deflationary reality. They were like 6-7 times earnings. And the point is that they may surprise on the upside in their policy response. So we should wait and see. But I think the central government, the local government, central government debt swap, and the bank recap are important signals. But what's still missing is a clear policy from the central government to remove that risk of buying primary property sales. You remove the risk of non-completions. You've got this white list, but it's not really the ideal solution for the market. So that's been missing for the last 18 months. But clearly, they seem to be targeting nominal growth now. Because the big technical problem in China in the last few quarters is that nominal GDP has been weaker than real GDP. Yeah. And the real decline in Chinese growth is only clear if you look at nominal growth. So in the 5 years before the pandemic, nominal GDP growth annualized 8.9%. Last quarter, I think it was about 4%. So that's the big decline in growth. So if the government's still looking at a real GDP growth target, that is kind of unfortunate because the real problem is nominal growth.
Over the course of the interview, I want to come back to India as well, because you said it's going to be one of the best performing markets.
Yeah, it has been.
It has been and continue to be, even though you've pulled back a little bit. But again, on China, we're still waiting perhaps for the Standing Committee of the National People's Congress to either rubber stamp and approve any kind of fiscal stimulus. We're waiting for that if there's going to be this big number. But we're also kind of waiting for that election in the United States.
On that point, I'm less... Personally, if Donald Trump's elected, it's obviously 50-50. The market will sell off China stocks in the first instance, and I believe that would be a good buying opportunity because actually I think from a Beijing standpoint, they would prefer Trump as president than the Democratic candidate. I don't think Trump's as bad for China as the market believes.
Why do you think they want Trump? Because they basically fulfill the geopolitical needs? Or why would Beijing want Trump?
No, because the track record shows that Donald Trump is not as anti-China as he's perceived to be. People have forgotten that Donald Trump did the big trade deal with China in January 2020. So in January 2020, the whole bilateral issues between US and China on economic policy had basically been resolved. A trade deal was done, and it was all hunky-dory. And Donald Trump was going to run on that presidential campaign as I'm the guy who's negotiated the best trade deal with China since WTO. But then, unfortunately, the virus intervened. Or not, I shouldn't say the virus, the pandemic intervened. And then about a few months later, he decided to run on the China virus angle, which actually is a bad idea from his standpoint, because if you're the incumbent, you need to run on a positive, not a negative. But the track record shows that he's not one of these national security guys in Washington who believe China's a threat to US hegemony. In fact, he's the opposite. So if I'm the Chinese, I would try and negotiate a deal where I ask for a quid pro quo, where I say, we understand you need to raise some tariffs because you've told your supporters that. But we're very much appreciate if you could relax these controls on our access to advanced semiconductors, because China, have no interest in invading America, but we do like your semiconductors. We're trying to, we're trying to understandably upgrade our economy. And by the way, we buy these semiconductors from U.S. companies, and this is bad for U.S. business. This is an angle which has a chance of getting some success. Whereas if Kamala Harris comes in, I'm sure it's going to be status quo. And we'll have the continuation of the current policy, which is driven by the national security lobby, where every year the controls are heightened or adjusted for technological advances. So to me, this is the policy that hurts China the most on the semiconductors.
That sounds like it might have a major market implication if Donald Trump wins, number one. If number two, he isn't as hard on China on their access to semiconductors.
Well, there's a chance they can negotiate a deal because...
Well, certainly better than the terms now.
Absolutely. This is I don't think China was prepared for this. The crackdown on advanced semiconductors. I mean, they're prepared now. The incentives now on China clearly to do it themselves, which in the long run I'm sure they will. But personally, Donald Trump likes to do deals. So do the Chinese, and they both understand reciprocity. So I think there's a chance. The track record shows that Donald Trump's not a national security guy. It's quite clear. Yeah, he doesn't believe China is a threat to U.S. hegemony. He just thinks China was smart and ripped off the U.S. in the WTO deal. That's a very different issue from saying China's going to take over the world or threatens U.S. hegemony. And as I say, these controls have hurt U.S. business. Right? U.S. business China's the largest customer of many U.S. tech companies.
Do we basically return to an inflationary environment, though, with 60% across the board tariffs on Chinese products?
Yeah, again, you see, I don't believe he's actually going to raise the tariffs as much as he's saying. But I think the Donald Trump line, which I saw the interview with your colleague, my former colleague, John Micklethwaite. So I saw the interview. Well, Trump's line on tariffs seems to be the following. I'm going to raise tariffs so high that I'm going to make it a huge incentive for people to move production to the U.S. And by the way, I've got no problem if the Chinese move production to the U.S. That seems to be his line.
Yeah. And I think the premise there was once he does that, they can immediately move factories like that to the U.S., which seems to be that's a separate conversation.
That's a separate. But bottom line, if Donald Trump's elected and Chinese stocks collapse, that's an opportunity to add to China.
I want to ask you also about maybe just on the macro front. One of the tail risks is, we're trying to do this dance between is the Fed going to cut 50 or 25 and how low do they get? One of the things you brought up in your report was, are we sleeping on the risk that monetary policy is just too tight, and we will only find out in 12 months' time when the data just turns like that? How would we approach a tail risk?
Now, that remains a risk. If you're a monetarist, you've had a big decline in broad money supply growth.
Which has dropped below, I think, trend line GDP.
Dropped below trend, but the point is there's been a huge base effect because the increase in M2 growth was so enormous back in 2020 that it's taken a long time to come down. So, yeah, we've only just gone below trend. So there is that risk.
Still soft landing, though? Is that a good assumption to have across most macro portfolios?
Well, frankly, I think this frankly, is the weirdest U.S. cycle I've ever seen. So I'm not being dogmatic about this. You could also argue that the U.S. is potentially picking up. There's so many weird things in this cycle, and I think that the unique features are driven by the pandemic. So, it's really strange that the labor market hasn't been more impacted by the much higher interest rates. Small businesses in America for the last 12 months have been paying 9 to 10% to borrow money. That it's amazing that. But maybe there's a sort of labor hoarding mindset. At least I think there is a labor hoarding mindset on the part of U.S. corporates because they had a hard time getting people to work coming out of the pandemic. So I'm not being too dogmatic about this, but clearly there have got to be stresses caused by these higher rates. But in the case of listed U.S. America, the interesting fact is net interest payments of the U.S. non-financial corporate sector have declined dramatically in this Fed tightening cycle for two reasons. One, U.S. big tech obviously have cash, so they're earning a positive return on their cash. And second, U.S. investment-grade corporates had done a very good job locking in bond yields when they were very low, and therefore extending their debt maturities. So the U.S. listed companies have been remarkably not impacted by higher rates. Again, many U.S. households have fixed mortgages. There's the area I think the consumption in America has been kept going by the baby boomers. The data shows big increase in share of spending by the 65 and over age cohort. That, to me, reflects the fact that they're beneficiaries of higher rates. For years, they were getting zero in the money market funds. Now they're getting 5% plus. That's basically icing on the cake. So to me, actually, the real stresses on higher rates in the U.S. are in the PE industry. That's where the real stress is.
Christopher.
But you can't see, but they're being funded by the flows into private credit.
Right.
Oh, yeah. Oh, that's a separate monster.
That's a separate issue.
Okay.
How long do you got?
Yeah, Christopher, we have to leave it there. We didn't even get to talk about India, but I guess if you're correct, 10 years, that story remains. Christopher Wood, Global Head of Equity Strategy there at Jefferies. Plenty more ahead here on shows. Hong Kong markets are down 0.5%, about an hour or so into the session here. The opposite is true. We need to get shares onshore on your screens. Plenty more ahead here on The China Show.
And welcome back. You're watching The China Show here on Bloomberg. Well, Malaysian Economy Minister Rafizi Ramli says the nation has the potential to hit 4% GDP growth. He spoke exclusively to Bloomberg's Haslinda Amin about how China's slowdown may impact the ambitious growth target.
Malaysia has always had this potential, and that's why I think it's acceptable to accept that at the very least, we must be growing at 4%, at the very least, because I think that's the bare minimum potential. The challenge is always, what do we do to push it higher? Closer to 5, beyond 5.
It's hard to talk about the economies in Southeast Asia, in ASEAN, without bringing China into the picture, because a lot of FDI from China actually flows into the region, Malaysia in particular. We're talking about a slowdown in China, a sluggish economy that's really struggling to reverse that trend. How is that impacting Malaysia, and how is that, I guess, being included in your own calculation when you take a look at Malaysia's growth?
It's, of course, the strength of China's economy impacts us directly, at least in the short term. Our currency does take a win from what happens in China. The trade numbers, our own exports and imports also will be affected by China. But I think that's the other side of the coin. With the slowing of China's domestic market, a lot of the companies, especially consumer products, electronics, high-end ones, have to look for different markets.
The China Plus One strategy?
The China Plus One strategy. I think in the past, a lot of Chinese companies contend that the domestic market was huge enough for them to grow without ever having to think going overseas. I think there is a rethink of that. A lot of these companies understand that with a lower kind of average growth in the next decade, it is better for them to find a foothold into the next big consumer market. And that's where ASEAN and its proximity and its culture...
So you're not too concerned about China's slowdown because...
I'm not too concerned. We have to manage in the short term, and that will affect us. We understand that. But there's a plus point to that. It comes with a lot of Chinese companies looking at ASEAN as the next market, and therefore I think we will be seeing more investments coming from China.
The thing is, Chinese companies investing in Malaysia carries its own risk in the context of US-China tensions. Those companies might just get in the crosshairs of tensions with the two, and Malaysia might just be paying the price for it.
It's a risk that we constantly looked at, and I think it's something that we have to build a certain framework for us to manage.
And in case we left you hanging, you can hear more on that interview in the next hour in our brand new program, Insights with Haslinda Amin. Joining us, of course, on the first episode are, you might know him, Carson Block and also Fatih Birol. Plenty more ahead. This is Bloomberg. Welcome back. We're looking at some weakness across some of the brokers right now on the back of this story that the CSRC is looking into several violations. That's story number one. Story number two is also in the CSRC urging are vowing support for small caps, and the Beijing Stock Exchange, to be more specific. So I think this next board shows you the SSE, which is a large cap index, and the next three small cap gauges. You have the Star gauge in Shanghai, you have the China X index, and you have the Beijing 50, which is, as you can see, it's up 13%. So it might sound like a paradox. Sizable gains across the small cap space. Looking at the space today.
Got to watch policy, and policy says it supports the CBSE 50, 13% up.
Yep, there we go. That's it from us here on The China Show. Stay tuned for Insights with Haslinda Amin just ahead. This is Bloomberg.